Hello guys, we'll be looking at today the top 5 companies that super investors like Warren Buffett and Terry Smith are investing in, seeing what aspects they share and why they might be good investments for us as individual investors. I'll be looking at their performance and ownership before carrying out a cash flow analysis for each company before we arrive at a fair value to see if they are a buy right now. If you like this sort of video and are getting something out of it, then please feel free to maybe hit that like button and consider subscribing to the channel. So before we get started, if this is coming to you on Christmas Eve like it is supposed to, then Merry Christmas. Hopefully you have a good Christmas Day and Boxing Day, and thank you for watching. As you can see, I've got my stockings behind me. No, that's not normally where I keep them, and yes, of course, I did put them up for the video. But it is getting me in the spirit, and the spirit of today is to look at super investors and how they are investing in the top 5 holdings that they own. Now, number 5 in ownership by super investors is actually, of course, one we're all familiar with, which is Meta, the social network and advertisement business that owns Facebook, Instagram and WhatsApp, among other things. This one has performed very well, up about 67% for the year to around $590 per share. Now, in terms of ownership, that looks like 22 super investors have this one in their portfolios, and that includes David Tepper and Terry Smith, who has over around 11% in his portfolio in just this one company. However, we can see, just looking here, that in Q3 of 2024, there has been quite a bit more selling than buying by super investors in this particular holding. So that's one thing to keep an eye on. Now, when we look at its valuation, currently its historical metrics in free cash flow don't look too bad, with a price to free cash flow of 28 times compared to a 10-year average of 29 times, signalling fair valuation. Whilst the operating cash flow is very similar at 18 times compared to an average that is exactly the same over the past 10 years. Now, the price to earnings looks slightly better at 26 times PE, whilst the average has been around 35 times, signalling undervaluation. So we have a stock that is around fair to undervaluation by historical metrics. If we factor this in to what we have in terms of EPS growth, which is from 2025 around 12% expected, and then 5-year EPS growth sitting a bit higher at 13.6%. So not bad metrics, but what do we have in terms of fair value? Well, when we play around with this metric in a DCF a bit, I prefer to be a bit more conservative when predicting free cash flow. At a conservative 12% free cash flow growth, well below the 5-year average for Meta, and then buying back around 2% of shares, that is actually the norm for this company. They trade at a multiple of around 23 times if I was being round about fair value of $575, which is quite a bit below the current share price of $590 or so. Now, I would say this doesn't offer that much margin of safety, but you could also argue that I've been too conservative in my estimates and price ratio. So I would understand if you sort of disagree with this particular finding of $575 as a fair value, but that's what I would sort of attribute as a sort of a fair conservative estimate. Now, moving along to number 4 in ownership at 25 super investors that have this one in one of their portfolios. And that one is, of course, Visa, the credit card network that facilitates the card transactions between retailers and consumers all over the world. And this one has done okay this year, sort of trailing the market only by a little bit, up 24%, just underperforming the index. Interesting enough, this is one I hold in my portfolio. As we can see here, I love the scalability and pricing power of this business model. Now, super investors have this one in their portfolios, the likes of Dev Cancerosario at Valley Forge Capital, making up about 6% of his portfolio. Terry Smith again at over 5%, Pollen Capital over 5%. Even Warren Buffett has a small amount of his portfolio in this particular holding at less than 1%. and we have a fair sort of balance, I would say, between buys and sells by investors in Q3 of 2024. Now, looking at historical metrics, we can see Visa is trading at a price to free cash flow of around 33 times compared to a 10-year average of 31 times, signalling slight overvaluation there. And the same for operating cash flow, sitting around 31 times compared to a 10-year average of 29 times. And they've got an expected growth rate that sits around 12% for the next 5 years. So altogether, I would say this sort of signals a bit of fair value to overvaluation for Visa from historical metrics. Now, from a free cash flow analysis standpoint, I'd say free cash flow could grow around 8% over the next 5 years fairly predictably. And then buying back around 2% of their shares, which is over the lower end of what they normally do, and giving a multiple of around 28 times, which is, as we say, a lot lower than the norm for this company, but it would be a more mature business in 2029. Therefore, we get a fair value sitting around $279 per share, which is quite a bit under the current share price. So my cost per share, for those that actually want to know, is around about $263 per share. And I would say this is actually just a small margin of safety for this position if we're taking this fair value that we've just come to. But I do think this is a predictable business model that will grow its intrinsic value into the future. So I didn't mind buying it considerably back a long time ago. And obviously the current share price, I would say, is a little above that fair value we've arrived at. Next, at third highest ownership by super investors, we have Amazon at 25 super investors that have this in their portfolios. Pretty much the same as Visa, although with Visa there is less ownership overall in terms of percentage. So with Pollen Capital having a sizable 12% in Amazon as part of their portfolio, along with David Tepper again and John Armitage. This is another holding in my portfolio, taking up quite a chunk of my portfolio. This one sits over 25% now. I think it's sitting about 26%. And it has performed rather well this year, outperforming the index at around about 47% in growth. Historically, Amazon is actually looking pretty good. Personally, due to their high research and development spending, I prefer operating cash flow for Amazon as a metric that sits at a sort of 20 times compared to Amazon's historical average of 27 times. That signals undervaluation just on its own. Now, their price to free cash flow also signals the same, because if we're looking at historical metrics, they have a 55 price to free cash flow compared to an historical 66 times. However, I would say that's very high. That's an incredibly high metric to make, 55 times price to free cash flow. But they are growing exceedingly well, growing it over 100% last year. So I would say that in more recent years they have grown it exceptionally well, and they now look at an EPS growth that sits closer to about 19% for 2025, and they expect a 31% CAGR over the next 5 years in terms of overall growth, which is actually very impressive and probably the highest so far amongst our top competitors. And finally, Amazon's DCF. Now, as I said, I prefer to be conservative in my estimates. However, Amazon's free cash flow, I would say, is just far from predictable right now. So I prefer to use operating cash flow just for this main holding, as I do think it's a key KPI for them. So right now, I prefer to use operating cash flow to try to predict the value. Now, say they grow this slower than the previous 5 years, I'll give them a conservative estimate of 13%, which is over half of what they have grown it as. But you could argue for a lot higher. And then with a slight dilution of shares, which tends to be their MO, and a price to operating cash flow of around 20 times, around what they sit at round about now, I would say, then we get a fair value of $233 per share above the share price, but with a margin of safety that is not really there. Personally, I was buying around the 180s, and I thought this was massive undervaluation. It was a 10-year low for their operating cash flow, and I just thought that no one was really seeing this as the main sort of competitor it was. And now they are starting to realise, with the share price going up considerably in the past couple of months. Now, I'm not currently adding to this position at these sort of share prices, although in actual fact, if it dropped below $200, that doesn't mean I wouldn't do so. Moving along, we get to our second highest stock in terms of ownership by super investors, and that is, of course, Microsoft, sitting at a count of 32, a impressive number of 32 super investors having this one in their portfolio. Now, this has underperformed against the benchmark this year, with the S&P up considerably compared to that 16% or so that we are seeing with Microsoft. In terms of investors, obviously we have the likes of Bill Gates at over 27% of his portfolio. There's no real surprise there, although he has been selling. And then we've got Chris Hone at 11%, adding to this one actually last quarter. And of course the familiar name of Terry Smith. I think we're noticing a bit of a trend here with him. Now, in the last 6 months we have seen a lot more sells than buys, and I would say this is actually something to bear in mind with this stock. When we look at the historical free and operating cash flow, I would say it signals overvaluation. As we can see here, the ratios are multiplying. They're getting bigger because the share price is actually outperforming the fundamentals of the business. Free cash flow sits at a lot higher than its 10-year average at 44 times compared to 29 times in the past. And although I will note this is actually inflated due to high sort of R&D into AI and similar things to the likes of what Amazon and Google are having to do, their operating cash flow is similar story, sitting at around 26 times compared to an average in the past 10 years of 20 times. EPS wise, they're planning on growing around 14% next year, and the same in the next 5 years or so. They're expecting 5 years of growth around 14%, which shows it's actually very predictable of a business and actually still growing very well for a business of its size. Now, when we come to the DCF of Microsoft, it doesn't look the best. If we factor in a growth in free cash flow of around 13%, around the 5-year average, which I would say is obviously something we could say could be taken lower by the investment in AI. We factor in small buybacks of shares and give them a price ratio of around 30 times price to free cash flow. We still get an overvaluation, a fair value of $356 per share, well below the current share price. Okay, now for number one. This is the number one stock that's owned by investors, and that is, of course, Google. Now, it may not appear so initially because they've only got 31 super investors that own this particular type of Class A shares. However, they do have 26 super investors with lots of overlap that own a lot of their Class C shares. So I sort of put them above Microsoft because of that sort of metric. There's lots of more ownership of Google, around over 3% in these super investors portfolios, so I would say Google deserves the top spot. This is also one that I own in my portfolio and is in my Trading 212 account at over 10% of the portfolio now. From a historical cash flow basis, this one is a similar story to Microsoft. I would have said their price to free cash flow looks inflated at 42 times compared to a 10-year average of 29 times, signalling overvaluation and just obviously the inflation due to the AI build out. Then we've got the operating cash flow is similar story, sitting at 22 times compared to an average over the past 10 years of 17 times. However, their price to earnings is slightly different. That sits at 25 times compared to the average of 29, which I would say signals undervaluation. So I would say it depends on which metric you prefer to put more credence to and want to put more faith in. Personally, I think that there's a bit of play with both. I do think their price to earnings doesn't tell the full story, but I don't think the free cash flow is the best metric to value this company by because of that AI build out and among other things, really. Analysts are expecting around 12% EPS growth next year in 2025, which I would say is quite conservative for Google. And then after that, around 20% CAGR in the next 5 years, which I would say is a bit more their speed. And that isn't really bad growth rates when we consider the price to earnings ratios that they're sort of playing at around mid-20s. The DCF model for Google doesn't really show a great share price, again, a bit similar to Microsoft. If we're using free cash flow, these ones are inflated at free cash flow because of the AI build out. But just to keep it in, Even with a growth rate of 15% in free cash flow at a price ratio of 25 times, we still get a fair value of only $163 per share. However, looking towards the price to earnings growth at 12%, which is a very conservative rate, I would have said, and obviously not in line with the 20% that we may see. That was given by analysts for 2025 at least. Then we get a conservative price to earnings around 20 times, which is obviously compression from the current ratios of 25 times. We still get a fair value that is pretty much in line with the share price. So again, we could argue that the PE looks good and the free cash flow doesn't look that so good. So I sort of fall somewhere in the middle, and personally, obviously, my cost per share basis sits around $167 per share. So I'm sitting slightly above that free cash flow fair value price with no margin of safety, and I'm fine with that for Google in my personal opinion, because I do think the PE has some weighting on that. Altogether though, these are the companies that the top 5 ones owned by super investors. And I own actually 3 of them, which I do think is quite strange. That isn't the reason I've done it, but it is maybe why I sort of looking at the sort of similar things as maybe what super investors are looking for in terms of businesses. All of them are trading above or around their fair value, if you ask me, and is in a considerably overvalued market as well. That being said, I do think it just doesn't take away from the quality of the businesses that they are investing in. I would describe all of these companies as potential monopolies in various different degrees in their industries, or at least market leaders. And obviously they're all heavy in tech, apart from, you could argue Amazon's a little bit more of a retailer, although I personally don't think so, with their cloud business and stuff like that. But they're highly margined apart from Amazon. So I would say that lots of these businesses are very much predictable and have grown impressively throughout the past years, and are probably safe bets for super investors to keep their money in for the future in terms of growth. And I do think they're likely to outperform the growth rate of lots of other companies in the S&P 500. But that's about it, guys. Thanks for watching. I do appreciate it, and I'll catch you in the next one.